Stephen, let me first get your take on what we heard from two Federal Reserve doves yesterday or overnight. They don't want to see a hike, basically, and are confirming that we won't see that in September. But they do want us to keep our eye on the balance sheet or continue shrinking the balance sheet, even as inflation fails to meet its goal. Are those two things congruently possible?
Well, I would say they are. But to answer your question very specifically, I'd focus on your description of the two speakers we've seen. They're doves. So we would expect that kind of rhetoric coming through. Having said that, we do have CPI this Friday coming out in the US. We're looking for a fairly decent number at 1.8% year on year at BNP Paribas. So we wouldn't say inflation is dead. We've seen a couple of months of a tick down. Let's see what happens going forward. Does it rebound again? Second point, you mentioned the balance sheet adjustment. This is a big one, and it's a particularly important for the bond market, and we would say the long end of the bond market. You could see some steepening. You could see 10-year yields rise. This is quite important for the market. We would actually highlight there's been a very strong correlation recently between particularly US 10-year yields and dollar-yen. So if you did see balance sheet normalization coming to the market, pushing 10-year yields higher in the US and the foreign exchange markets, the best trade behind that is probably long dollar-yen.